Welcome back to Fair Fiat Investing. Today we'll be discussing Tesla stock, ticker symbol TSLA, currently trading at $246.93 a share. We've got market cap of $784 billion and an enterprise value of $769 billion. Jumping right into it, a couple things I noticed right away: high amounts of cash in relation to their debt, and a lot of green in their margins in relation to their industry and history. So looking at the cash to debt is sort of a indication of how exposed the company is to risk. So we do see the trend line increasing versus history. This is almost the highest amount of cash they've had in the last 10 years, well above the median at 3.19. So they have $3 for every dollar of debt. When we look at their gross margins, they are right about the median, and versus history, this is below the median of what they've had for gross margins. The gross margins represent the money that a business makes after removing the direct cost of goods. So it looks like they're making a little bit less than they were after the cost of their goods. So with supply chain issues and whatever else might be incurring further expenses, it looks like they're making a little bit less off of the cost of making their Teslas. When we look at the operating margins, currently they're at 11.2 and their maximum is 16.98, so on the upper end of operating margins in the last 10 years. Net margins, they've got 11.24 with a maximum of 15.45. So it looks like we're seeing a little bit of margin decay just due to their gross margins being hit, but still in a fairly good realm for operating margins and net margins. Their free cash flow margins are at 3.8, whereas their maximum is 9.27. So all in all, the margins for the business looking like they are taking a little bit of a hit since the gross margins have gone down and expenses have risen slightly. Looking into how the management is running the company, we have return on equity, return on assets, return on invested capital, and return on capital. A lot of green. We do see the trend lines increasing all throughout the graph here, and a lot of green for historical performance for management. When we look at the PE ratio, we see that versus history, their median's 147, minimum of 31. So they're still on the lower range of their price to earnings ratio, but 79.4 is still a high amount of growth priced into the business. And we can see right here that they are one of the highest price to earnings ratio companies in the industry, with a median for the auto industry at 17.25. They're currently at 79.4. With their trailing 12-month revenue at $95 billion and a current market cap of $784 billion, they're trading at roughly 8 times their trailing 12-month revenues. Looking at their trailing 12-month financials, we see that the revenue is increasing over time, good sign, although it looks like their net income and EBITDA is relatively flat, even though the revenue is increasing. We do see that the cash to debt is in a good position. Their cash has always outpaced their debt, and their debts are being decreased while their cash pile is increasing. We see no share buybacks, actually share sales, so decreasing the value of every share. When we look at their business segments, energy generation is at 4.8% and their automotive is at 95%, so heavily weighted in the auto sector. If there was a hit to the automotive, then a significant amount of their revenues would be decreasing. Currently their geographic is 22% in China, 49.8% in the United States, and about 28% in other segments. Their revenues by geographic region are steadily increasing, both in the US and China and everywhere else. But to get an accurate assessment of where this company could be headed in the future, let's run a VCF. So we see right away this business has low predictability, and we can base this off earnings per share or free cash flow. When it comes to earnings per share, there's no data for the 10-year, 5-year, and 3-year periods. But when we come down to free cash flow, we do have one to base numbers off, which is the 3-year growth rate of 81% for free cash flow. So looking at their free cash flow growth rate, currently there's about 49% priced in to growing free cash flow over the next 10 years, which is substantial growth. And for a company to generate this much growth would be a very tall challenge. Elon Musk could pull it off, but 49% growth over 10 years is insane amounts of growth to be priced in. Even with that 3-year of 81%, potentially more reasonable, although still a high growth estimate, could be around 30% over the next 10 years on average, which would leave us for a fair value of $72 versus the current of $246. So at 49% growth every year for the next 10 years, giving us a fair value of right around what it is today, that means they would have to achieve higher than that, in theory, to have some upside value. This is my theoretical framework and assessment of Tesla. Leave a comment below if you have questions or want a company reviewed. If you enjoyed the video, please leave a like, and see you next time.